Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 158. And in this episode, we are reviewing the performance of the global markets during the 18th week of 2025. And that is from Monday, the 28th of April to Friday, the 2nd of May. And without further ado, this is your host, Jamuhuri. And together, let's dive right in. We kick it off in the United States, where the growth in employment was stronger than expected in the month of April. And this was despite worries about the impact that President Trump's trade tariffs would have on the U.S. economy. According to the Bureau of Labor Statistics, nonfarm payrolls, which measures the number of jobs created in the U.S. economy, excluding farm workers, this increased by a seasonally adjusted 177,000 new jobs in April, which was slightly below the downwardly revised number of 185,000 new jobs in March, but was way above the Dow Jones estimate for 133,000 new jobs. Meanwhile, the unemployment rate held steady at 4.2%, indicating that the labor market is relatively stable for the time being. However, a broader measure of unemployment, which includes workers who are holding part-time jobs for economic reasons, this rate edged lower to 7.8% as the labor force participation rate ticked higher to 62.6%. Following the better-than-expected jobs report for the month of April, President Trump was back at it again, calling for the Federal Reserve chairman to lower interest rates. Trump's continued efforts to influence the Federal Reserve's decision-making process on monetary policy is challenging the long-held independence of the central bank. And nevertheless, like most major central banks, the Federal Reserve is an independent institution that is not influenced by short-term political considerations, but instead relies on solid economic data to determine the direction of monetary policy. Looking at inflation in the United States, on Wednesday, the U.S. Bureau of Economic Analysis reported that the Personal Consumption Expenditures Price Index, which is the Fed's preferred measure of inflation, edged lower to 2.3% in the 12 months to March, which was down from a rate of 2.5% in February, but still came in above market expectations of 2.2%. Meanwhile, the core PCE price index, which excludes volatile food and energy prices, this rose by 2.6% in March, which was in line with market expectations, but was down sharply from a reading of 3% in February. Even with inflation moving lower in the month of March, the outlook for inflation in the medium term remains uncertain due to the ongoing tariff war, which is why the Federal Reserve is widely expected to keep its policy rate on hold at its next policy meeting this coming week on the 6th and 7th of May. Staying in the United States, the U.S. economy contracted in the first quarter of 2025 as imports increased sharply, with American companies and consumers seeking to get ahead of President Trump's trade tariffs, which were implemented at the beginning of the second quarter. According to a report released by the Commerce Department on Wednesday, the gross domestic product, which measures the value of goods and services produced within an economy, this declined at an annualized rate of 0.3%. This was the first quarter of negative growth in the United States since the first quarter of 2022. Economists had forecast a growth rate of 0.4% after the U.S. economy grew by 2.4% in the fourth quarter of 2024. The contraction in economic growth was mainly attributed to the unexpected rise in imports, as well as a slowdown in consumer spending and a sharp decline in federal expenditure due to the ongoing efforts of Elon Musk and his Department of Government Efficiency, better known as DOGE. A quick update on the tariff situation. Governments across the world are trying to minimize the disruptions caused by the trade tariffs. The uncertainty over trade policy has destabilized investors and sent global markets into a tailspin. The Federal Reserve Chairman Jerome Powell has said that the economic effects of higher tariffs would include higher inflation and slower economic growth. Ironically, and in a twisted sense of poetic justice, the U.S. consumer could become the real victim of tariffs. A reason being that the U.S. imports a lot more from China than China imports from America, and this implies that the U.S. consumer has more to lose as Chinese imports become more expensive. As mentioned earlier, the U.S. economy recorded negative growth in the first quarter of 2025, and now with the implementation of trade tariffs by President Trump on the 2nd of April, it is highly likely that the U.S. economy will slide into a recession in the second quarter of 2025. For your information, an economic recession is defined as 2 consecutive quarters of economic contraction. Moving over to the Eurozone, flash data released by Eurostat on Wednesday showed that the Eurozone economy recorded a stronger than expected growth of 0.4% in the first quarter of 2025, as the ongoing tariff war cast a long shadow on the future direction of economic growth. As U.S. tariffs come into effect, economic growth in the Eurozone is expected to slow down sharply in the next 6 months unless the Europeans can negotiate a trade deal with President Trump. Economists polled by Reuters had expected a growth of 0.2% in the first quarter of this year, following a revised growth of 0.2% in the fourth quarter of 2024. Figures published earlier on Wednesday showed the gross domestic product of Germany, which is Europe's largest economy, rose by 0.2% over the same period. Staying in the Eurozone, flash data released by Eurostat on Friday showed that Eurozone inflation remained unchanged at 2.2% in the month of April. Economists polled by Reuters had forecast a lower rate of 2.1% in April compared to a reading of 2.2% in March, as inflation was easing back towards the European Central Bank's target rate of 2%. Meanwhile, core inflation, which excludes volatile food and energy prices, this accelerated to 2.7% in April, up from 2.4% in March. During the previous week, the ECB President, Christine Lagarde, confirmed that the process of disinflation was on track and that the central bank was heading towards its inflation target in the course of 2025. However, other policymakers have warned that the ongoing tariff war with the United States could complicate the outlook for inflation in the medium term. On Wall Street this past week, the stock market breathed a sigh of relief on Friday morning as the latest jobs data came in better than expected, but the fear of a recession was still simmering in the background. Investors were also upbeat about China, which said it was evaluating the possibility of starting trade negotiations with the United States. The S&P 500 advanced by 1.47% on Friday to mark its 9th consecutive day of gains and its longest winning streak since November 2004, before coming to a close at 5,686. Meanwhile, the Dow Jones Industrial Average jumped by 564 points to end at 41,317, and the Nasdaq Composite gained by 1.5% and eventually settled at 17,977. In the government bond market, the yields on U.S. Treasury bonds jumped on Friday as investors cheered the better-than-expected jobs report for the month of April, which showed that the U.S. labor market remains resilient. Investors were also encouraged by a statement from the Commerce Department that indicated that China was evaluating the possibility of starting trade talks with the United States. The market is now looking ahead to the Federal Reserve's next policy meeting, which is scheduled to take place on the 6th and 7th of May, and traders are largely expecting the Fed to keep its policy rate on hold at between 4.25% to 4.50% and expect the central bank to maintain this level until July. The yield on the benchmark 10-year Treasury bond rose more than 7 basis points to 4.30%, whilst the yield on the 2-year Treasury note surged by more than 12 basis points to settle at 3.82%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equivalent to 0.01%. In the commodity markets, the price of crude oil fell over 1% on Friday and recorded its biggest weekly loss since the end of March, as traders shifted their focus to the upcoming OPEC meeting, which is set to decide the group's output policy for the month of June. The Organization of Petroleum Exporting Countries and its allies is scheduled to meet on Saturday this coming week and will be considering whether to further increase oil output in the month of June. Traders brace for an increase in oil supply at a time when the US and China are engaged in a trade war that is expected to slow down economic activity and in turn reduce the demand for crude oil. In response, the price of the US benchmark, that is West Texas Intermediate crude, this was down by 1.6% to settle at $58.29 a barrel, whilst the price of the global benchmark, Brent crude, fell by 1.4% to close at $61.29 per barrel. In the precious metals market, The price of gold edged higher on Friday, but easing trade tensions and a strong U.S. jobs report kept the price of bullion on track for a second consecutive week of losses. A statement from China's Commerce Ministry indicated that Beijing was open to talks with the United States, which has also expressed its willingness to start negotiations on trade tariffs. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to thrive in a low interest rate environment since it doesn't offer a regular coupon like a bond. A combination of central bank purchases together with investor flows into gold exchange traded funds and the prospect of further rate cuts by the Federal Reserve has supported the rally in gold, which has seen the price of bullion rise by more than 25% so far this year. And after hitting a record high of $3,500 on the 22nd of April, the price of spot gold was down by 2.1% this past week and eventually came to a close at $3,255 per ounce. We now change scene to the Kenyan financial markets. And we start by looking at the cost of living in the country, where the latest data from the Kenya National Bureau of Statistics shows that headline inflation increased to 4.1% in the month of April, which was higher than the previous rate of 3.6% that was recorded in March. Meanwhile, core inflation, which excludes volatile food and energy prices, this increased to 2.5% in April, up from 2.2% in March, and was mainly driven higher by processed food items and energy prices. In the domestic foreign exchange market, during the past week, the Kenyan shilling appreciated marginally versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.34 compared to 129.54 that was recorded the previous week. Meanwhile, the sterling pound was priced at 173.21 and the euro was valued at 147.16. And on the regional front, one Kenya shilling was changing hands for 28.34 Ugandan shillings and 20.72 Tanzanian shillings. And to the Rwandese franc, it was posted at 10.91. The Kenya shilling continues to trade within a narrow range versus the US dollar. And barring any exogenous shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves decreased by $56 million for a grand total of $9.74 billion, which is equivalent to 4.4 months of import cover. This level of reserves is in line with the central bank statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, During the past week, the interbank market was sufficiently liquid and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other on an overnight basis, this was broadly flat at 9.94% compared to a rate of 9.95% the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 7.7 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Wednesday, the 30th of April, and the central bank received bids totaling to 18.3 billion shillings against an advertised amount of 24 billion shillings, representing a subscription rate of about 76%. The central bank accepted almost the entire amount of 18.3 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 3.7 basis points to average out at 8.40%, whilst the 182-day rate held steady at 8.61%, and the 364-day rate slid by 1.5 basis points to settle at 10% flat. In the primary bond market, the auction for the second bond issuance in the month of April was held on Wednesday, the 30th of April, and the central bank, which had offered for sale 2 reopened fixed coupon treasury bonds, ended up receiving bids totaling to 57 billion shillings against an advertised amount of 50 billion shillings, representing a performance rate of about 114%. The central bank ended up accepting 50.3 billion shillings, and the results of the auction were as follows. For the first bond, which was a 15-year bond with 12 years left to maturity, the central bank accepted 25.2 billion shillings at a weighted average rate of 13.91% compared to the bond's coupon rate at 13.94%. And for the second bond, which was a 25-year bond with 22.5 years left to maturity, the central bank accepted 25.1 billion shillings at a weighted average rate of 14.53% compared to the bond's coupon rate at 14.18%. Please note there is a third bond still on offer. This is a 20-year bond with 7.6 years left to maturity and a coupon rate at 12% flat, where the central bank is looking to raise a total of 30 billion shillings from this bond, which is still open for sale until Wednesday, the 7th of May. Up next is our topical issue. And this week, we're looking at the conditions set by the International Monetary Fund in order for Kenya to unlock new funding. The National Treasury and the Central Bank have disclosed that Kenya must meet the set revenue and expenditure targets in order to unlock any new funding from the International Monetary Fund. Before signing off on a new credit facility, the IMF is eager to see the final budget estimates for the upcoming fiscal year, that is 2025-2026, together with the accompanying revenue-raising measures. The conditions set by the IMF have put the government in a sticky situation following the public demonstrations that erupted last year when the government unsuccessfully attempted to increase taxes. The central bank governor finally confirmed that missed revenue and budget consolidation targets were the main reason why the final review of the previous IMF program was abandoned. Please note that Kenya missed out on $850 million in the final review of the previous IMF program. For your information, the IMF provides support to countries either through the Extended Fund Facility or the Extended Credit Facility. The Extended Fund Facility provides financial assistance to countries facing serious challenges with their balance of payments due to structural weaknesses that require time to address. Whilst the Extended Credit Facility provides financial assistance to low-income countries that are facing protracted difficulties with their external debt repayments. The expiry of the IMF facility, coupled with the government's inability to raise additional revenues, has left the national treasury with a massive budget deficit that raises the prospect of further borrowing, a development that is likely to cloud talks for a new IMF funding. And according to a draft of the Finance Bill for 2025-2026, which was tabled in Parliament last week, this shows that the government this time around has refrained from aggressive tax-raising measures and instead opted to focus on sealing revenue leakages as it seeks to avoid a repeat of the youth-led demonstrations that rocked the nation last year. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please consider supporting this podcast by becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the best way to predict the future is to create it. Think about it. Thank you, and God bless.